right, good evening, guys. Ken at Tortoise Capital, nightly strategy podcast for Sunday, January 9th, 2022. We got a handful of frames from Chi-Wing Chong to review tonight. And then I have a few extra slides I want to cover for the foundations guys to play a little catch up with them. All right, so the first one we have is Alcoa, where he's using the weekly, daily, hourly frame of reference. That's our standard. It also doesn't surprise me if we use the 30-minute instead of the hour. We would do that if we were looking to be aggressive on the intraday trade. So like if we were hybrid trading both the day, the daily chart, and then also the intraday chart, a 30-minute frame gives you a little more flexibility. You can even take that as low as a 10-minute frame and get this combined effect of swing trading and day trading. That's a classic hybrid move. That's the same way if we were looking at, we might use a 3-day combination of like a 3-day over here and a daily, or even a 3-day and a weekly. Gives you, if you're looking to operate across two time frames, both of those work pretty nicely. The 3-day is especially good at smoothing out a lot of the noise, and it gives you sort of a faster swing trade than a weekly, but it starts to diminish the impact of the overnight gap because you get 3 days now of movement. All right, so we're taking a look at Alcoa. Chi-Wing, when you hear this, what I'd like you to do is start adding the yellow box to show your actual risk box. You'll notice that on Ken H's that he shows explicitly what his risk box is going to be. So when we see those yellow boxes on his charts, and we'll post them in the public space, I'd like you to do that so that we could see. Then it's what's implied is that if it breaks out of that box above, then that's where I'm getting long. And then if it breaks below that, that's where I'm getting short. And then I'd like you to make these blue lines, I'd like you to make them green. If you intend to enter a position, you know, when price crosses that, if that's an entry, then make that line green. If it's just a reference line, then blue is fine. If it's a target that you think it can get to, you know, like if I was going to get long here and I thought it was going to go to 67, I'd put a purple line there to show that as a target. And then that tells me what my reward to risk is on the primary trade. Now, as I'm interpreting this, I'm going to take this as your risk box. So long at 69.23, short at 61.68. And then I'm going to operate on that assumption. Which gives us about $1.30 of risk. And then now there's no resistance overhead on this one at all on the weekly. So it's reasonable to just say, look, there's a target at 65. And then let's see, that would be about $6. So the red line would be up around 71 for the Z3 on the daily. Now, how can that be? Now that's interesting that the width between the Bollinger Bands is wider on the daily than it is on the weekly. And that has to be because the daily volatility, this distance, is greater than this distance on the price basis. Kind of interesting. Because you notice Z2 here is at 65 and over here it's at 62. Kind of interesting. All right, so I'm going to take the upside as, let's see, if we said 65 and you're getting along at 63, so that's a $2 gain, and then $2 more to 67. That would give you $4 to the upside on a $1.30 risk, which is 3-1, and that seems reasonable. So halfway up the stack seems like a reasonable effort. The last consolidation area was about $3. It was about a $3 in here. And so the size of the move was this. 50, call it 52 to 59. That was a $7 move on 52, which is about 13%. Which would make a move of that magnitude from here would be an $8 move. So taking just half of that as 4 says 67 is within reason in a period of time of 5 days. So yeah, it can move $8 in 5 days. So 67 is reasonable. This gives you a reasonable upside, a reasonable short, I think. And my target would be to 59. And if it broke, you're looking to add a second position that early. I think that's early because it hasn't proven anything yet. When it fails that far, that just looks like regular noise. It's not till it penetrates below the dragon. It's not until this line is breached at 59 that you can say, oh, there's evidence that something's happening, in the same way that a break of the PSAR dot is a reason to add a position. I don't know that I would add two position, a second position here and a third position that fast, only $1 apart. The only way I would do that is if I was if I was day trading it and made money and then kept a piece, then I think that's actually a place to have 3 short, because now your target's going to be 53, because now this big long PSAR has violated. So I like this one. I don't mind getting short here. I would think twice before adding a second here and then a third one here and then a fourth one there. I think you got to pick one or the other. And this one feels like it's too early to me. It hasn't violated anything yet. I think I would advise, get short one here and then get short a second one here. Then I would be day trading it intraday and say, now, if this breaks, add a third, but not until then, because it could come down and hit that support level like it has in the last 4 times. And after that, it went up each time. So I would not be wanting to add a third position right where I'm expecting it to find support. So I like front running that a little bit here at 59 and then wait and see. Then if it starts to stall, cash it. And then if it breaks through, you have time at about 57.50 to add a third position, because then this is in free fall. So I don't want you to get too large of a position in here. All right. So when we translate this over to the hourly chart, you're waiting to see this break below the skin, the upper skin of the dragon, or breaking out above the top. If you were going to day trade this thing, I'd probably put that box really tight, like about a 20-cent box, and I would try to day trade it to here. And then if it broke, I would commit to holding a position overnight. I would hold 1/5 of the position overnight. So I would day trade it from here, then plan to keep a piece. And then I like this as a second entry here. Yeah, so that's 60. That's this one. Yeah, I think I'd have to be day trading it to get that second position. Like I said over in here, if you're going to be aggressively day trading this one, then I think those lines are fine. But I would also look at adding one right here. So interesting frame. And then obviously, if it breaks below these two, down it goes. That's this one. That's the key price level in here. This level at 58, if that breaks, then it really does get crushed. So that's this one in here. Yeah. All right, Devon Energy also has cleared, also has cleared the big choppy area. And then the strength and energy that carry this up. So this is still really early days. All of these shorts would be a reaction to the fact, hey, if this thing starts to fail, then the least surprising move would be it comes back to 44. And then that gives him, he can scale into a position that'll be large on that move. These only make sense, like on the other one, inside of the day trade. So breaking the skin of the dragon, breaking the PSAR, breaking the Bollinger Band mean. This one is a violation of the belly of the dragon. I would recommend bring that down to here to the leaving the river. So if you had 4 positions on this thing by the time it leaves the river, heading back to 45, you'd be pretty happy. I would have to take this as a day trade to get 4 positions on. But those are all at the right spots. You just notice that Devon Energy gives you plenty of daily travel distance at 46 to 48. So it's moving 5% intraday. You know, a $2 move on that is not unusual. So that makes it a pretty good day trader in here. The fact that this had consolidation, a small consolidation, then started to roll over, makes me really like the downside on this one. The upside is easy to see. Yeah, 1, 2, and then if it gets up here to 3, because there's nothing holding it back, and then you'll be in great shape. But this is one that the energy sector has been so strong here most recently that this one is well positioned. Russell, this has been just sideways and horrible, for the last 3 months. All it's done is this grind around 224 to the point where that even was getting a pinch. When that pinch broke, you got one move up, quickly reversed back into the fold, had a second leg down, rebounded, and now is stuck. It's stuck still right in the middle of this move. But what's nice is it's hovering right on the edge of the belly of the dragon and the RL10. Oh no, I'm sorry. That's right there. The RL10 right there, and the RL30. So that 212 is kind of a key support level. 212 is a key support level. So you'd like to have, as you do, you want to get at least 2 positions short, and then adding the third one at 208 looks reasonable to me. All right. So as soon as this thing breaks below 215.60, he's starting the launch south. Yeah, because it's had 1, 2, 3 chances to find support. Each time that it found support, 1, 2, you can now notice that the size of the upward move is diminishing, which suggests that if this does break, that first move down out of this could be large. So I like that. You're waiting to see 220 to get long. And so he's waiting. He's not going to take any position in here until it absolutely clears. I think if you're trading the futures on this one, or you're on the 1, 3, 5, or 10-minute bars, I think you can actually put your risk box like this. I might even be able to go like that and then try to make this trade from here to the Bollinger Band mean. I mean, that's $4. And if you're risking $1, you could get 4 to 1. But I respect the idea of being ready on the short side. The short side is going to be the big payoff on this one, because if this is like thin ice, if that cracks, that's all of that pressure downward is going to run to the downside. And then you're looking for 212. If it does break there and you come down here and it doesn't fail through there immediately and starts to reverse even a little bit, I would take that in a heartbeat, because then it's finding support where you would expect. And the last time that it did, it was a massive move up. So play this one short from here, wait for the test, be ready to cash. And then I like that as a second and a third position for the downside. The upside's easy to see. You're adding a second position here on a break above the hump of the dragon. Here it's almost at the Bollinger Band mean. That looks good. U.S. Steel. Oh, this is a beauty. This isn't a reason why we love the Kata 2. So here's a Kata 2 on the weekly, right? You have a low, a higher low. Along the way, the PSAR flipped, so you've got some upward pressure. The RL10 reverses, crosses the baby dragon. Price, meanwhile, has rocketed through the top of the dragon. So on the weekly basis, you would have loved to have been long at 25, which is here on the way up. But notice that while you're waiting for the weekly chart to really catch the reversal and start to flow up, the daily 1, 2 gives you a Kata 2 here. When that PSAR gets violated, there's your entry, there's the PSAR flip, and you can either pick a risk box of the belly of the dragon, which is about 75 cents, or you may have used the PSAR box, which is about a buck and a half, and that's connected again to the bottom of the RL10. And then it crosses the Bollinger Band mean, turns to summer. This is where you might have really been tempted to get, a second position here. And then you have a nice successful SSC in the bank. And now this thing rolls down, touches the dragon, and then the last move of the day on Friday was this nice strong move. You can see that on the daily, but you can trade that on the hourly. Notice how you're getting a nice strong Kata 2 There's your RLXD. There's your entry if it takes the PSAR out. So you could already be long on this thing from either 25 or 25.20, and you'd be very happy with that. So you're looking to get to 26 on the hourly, which is back up to here. And now what I want you to step back and look at this one from a little bit wider angle. And this is the, sort of the famous cup. We would sort of expect this to get back to 26.50. And then the cup and handle pattern is if it does get back to here and then sells off and then goes up again, that's going to give you this kind of a kata 2. And so you can buy it in here or buy on the breakout, thinking that the sell off was rejected. Then there was a little bit of pause of profit taking and then immediately is resumed. This is a really strong cup and handle formation. Technicians, pattern seekers would find that. What I want you to notice is that when you know that people who are technicians are waiting to see a return, a pullback, and then an immediate resumption, you know that is always out there waiting and latent urgency to buy by the conservative crowd, right? You can actually see that happening on the hourly. There was a nice move up to the top, pulled back slightly and is starting to go, and that's buying the handle. And then if this gets above 26, that thing is really going to go. So the person that is entering here on the hourly at 25 with about a 20-cent risk is trying to catch a dollar move just to here. And then if it follows through, you get a second position and up it goes. But if this thing fails, if that support fails, then you know it's coming all the way back to 23.50, which on the daily chart is back here. So if that fails, this thing comes all the way back here. And now notice he's got the entries on the downside to support that. I say all that so that I can say the following, that one of the reasons we like the SSC is that we're seeing it at the halfway mark, at the point where everybody who's going to sell was going to sell. If this thing was still horrible, this thing would not have gone sideways choppy here. These two moves would have continued and broken, but it hasn't. This was an effort by people, by buying pressure, and then they have won the next round by taking it back up. Well, when we start taking our entries in here, whether it's an SSC or a kata 2 or something like that, what we're betting on the hypothesis is that if this thing is going to work and go to become a cup and handle, then this swing low marked off by the RL10, or even at some point by the dragon, I'm now a big fan of the RL10, that's going to hold. That's the strong support. Conversely, my favorite pattern is the CD, the collapsing dragon. So if this thing starts rolling up, and if it ever fails, I should have made that black. If this is moving up and then for any reason fails, when it fails through the belly in here, that's the collapsing dragon. So this original, wherever it finds that first support level, takes on a really important value. Well, now when we take this logic over into here, we can say, this belly of the RL10 is really important. So if you buy the SSC or the kata 2, you could see that as an SSC because it had a harsh move down, crossed the dragon. Maybe you bought this one. Maybe you bought the PSAR flip. The PSAR is getting ready to flip when the RL10 goes through. It'll flip tomorrow. But anything below this thick black line at that belly of the RL10 is a collapsing dragon, and it's going to come back to 2350. So those turning points matter. In the same way now, when I bring this back up to look at the peak of the dragon and the peak of the RL10, these two prices are what's holding the man down, right? That's where they couldn't push it any further and it failed. So this time, if it comes up with new energy and then breaks through 27, this thing is long gone. There's nobody left to fear. The initial surge above 27 could either take us up to 2850 or as high as 3050, which now would be a Z3 and a Z2 and a Z1. So now on this breakout, that's like a checkpoint. Correct, 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 and then up it goes. So we're just using a little bit of architecture to frame these trades. And the template that we're using to fill in is that when this is the hard right edge, and we haven't seen this move yet, and we see this kind of a move and it's holding, that's why we like this, because we are filling in that template with our mind's eye that says a move back to the previous test is not outrageous. That's what everybody who wants to go long is believing in. The only difference is that we don't believe it. I'm just trading. What I believe in is that if that RL10 belly breaks, I'm going to be on a collapsing dragon as my number one favorite pattern of all time. So any break in here, if in this climb it ever falls, what I'm really looking for now is this violation of the RL10. If that breaks, then the collapsing dragon is in play, and that's where I want to be. Well, if that's my favorite pattern, then why am I taking these secondary patterns? Oh, because they work often enough that you can get paid. Now, how good is it to conceptually trade your second favorite pattern, knowing that if it works, you're going to get paid well, but if that it fails, you're going to get to be in your favorite trade, which pays even better when it works. That's a good place to be in. And you're playing the law of large numbers on that. Is this the one that's going to work? I don't know. I'm just going to trade it. All right, the final one I want to talk about here is one Chi Wang Chong offered. This one is so good that I'm gonna demand that as an intern or a apprentice that he does this. This is a really good chart. So as you know, the slope of the RL30 expressed as a Z-score is my personal favorite for understanding market condition within context, right? So here's the all-important zero line. And now what he's computed is the Z-score of the RL30 slope, all right? So to review, we got 30 bars of price. And then the straight line regression, the 30-period regression line, is the straight line that is the best descriptor of that price action. All right. Now, if we said that was a zero slope, perfectly flat, then this angle A, the bigger, if this was case one, we'd rather have something that was like this, all of the things being equal, I'd rather own 2 than 1. Because why? Because it's going up faster and farther, and the angle B is bigger than angle A. So we want better slope is better. Higher slope is better. Better is better. It's technical. So what's the z-score mean? Because this is just from one moment in time. We're looking at it today, and we're looking back 30 days to come up with the slope of that line. Well, let's take XLK. So what we're going to do is we're going to look back 180 days. And for each of those 180 days, so a day like minus 180, we take the 30-day regression line slope, we measure that, and then we score that number, and then 179. So for each of the last 180 days, we compute the slope value of angle A. And then what we do is we sort that, and then we find the maximum, the minimum, the average, and then the standard deviation of that, +1 and -1. And then we take today's slope and we see where it fits inside that stack of 180 data points, right? If this is the average and it comes out to be 1 standard deviation better than average, it gets a z-score of 1. If it's 1 standard deviation below that 180-day average, it gets a z-score of -1. So when we think of this as a z-score ladder, 2, -1, -2, you can take a look at today's price and say, oh, that is on a relative basis how good today's price is. Well, when you put a time series of those together, you get a second derivative of slope, and you're looking at the flow of you're looking at the ebb and flow of its 30-period market condition, if you will. Now, what's really important is noticing the turning points at z plus and -2. All right, between 0 and 1, 1/3 of the data can be found, and between 1 and 2, or between higher than 1 and all the way to the max, about 1/6 of the data. And between 1 and -1, about 1/3 of the data. And between 1 and the rest is about 1/6. So this bulk of the time these guys spend between plus or -1. So this is like the giant rubber bands. When they start stretching, they can only go so far till you start getting the turning points. Now I want you to notice when you put technology versus materials versus energy versus finance, there's something really important and useful. This is evidence of sector cycling. Like at this moment, both materials, XLB, and tech had reached a Z-2 minimum, a low, and then started to get better. Money started buying them when they were on sale. Hey, we can buy technology and steel companies on sale. Let's do that. Instead of paying a premium for energy, we could be buying materials and technology when they're in a downtrend and starting to reverse, and instead of paying top. So let's sell our energy and buy tech and materials when it's cheap. Well, when that happens, you see energy roll over, and then you see materials, tech, and in this case, finance, all starting to rise while oil prices are tumbling. So what you're seeing is the routine sector cycling expressed. You're looking at the underlying trends of the currents, if you will. So here's when energy was rising, materials and finance were falling. And then tech started to fall. So those Z2 moments are really useful. Now what I want you to see, so finance has had a really good run. Materials, this is so good. This is how good materials and the steel companies are, is there's almost a Kata 2 formation in there. So the steel companies have really been benefiting from that. Now notice that tech, on the other hand, has almost like a Kata 2, but to the downside. It peaked. There was a little pressure, and then it's starting to fail again. So is this going to come all the way down to Z-2? Stand by. What if this holds here? That would be good, because then it'll become the leader again. So we're at a real crossroads right now as we look at, there are three things that are rising. Finance and energy are really looking good, but you can already see material starting to roll over. And you can see tech diminishing. So all other things being equal, if I saw another strong day in finance and energy tomorrow, like in Devon Energy. So if I'm playing XLE, I can look at Devon, Chevron. If I'm looking at finance, I can just look at FAS, triple finance, or I might look at JP Morgan, Goldman Sachs, etc. So I'm going to ask Chi Wing Chung to keep us updated with this on every weekend so that we can get a feel for those four sectors. Because of the 10 sector spiders, these four seem to be the strongest independent trenders. Tech is often the engine that's driving the market forward in great leaps, but materials, energy, and finance work according to their own drummer, and they can be out of phase with the S&P altogether. The one thing I'm going to ask him to do is add SPY to this so we have a baseline. So I wanted to say that. Really good work. I've added a flashcard in Campfire for us. There's just a quick summary of the indicators and how we set them up. There is a summary of the main patterns of the foundations. There are these two supporting flashcards that describe those three patterns, the SSC, the Kata 2, and then the collapsing dragon. So if this thing fails and fails through that line, this is where you get that collapsing dragon, right? Remember, all of it starts off with a harsh winter. Another way to look at that is this flashcard also. We call the sight picture, that we've had a harsh winter. The harsher, the better, as measured by, the RL10 is diminishing and the MACD goes into harsh winter. And so both the RL10 and the baby dragon are dropping. The first alert is when the RL10 rolls over and starts moving up. We know that's going to be where that PSAR flips to, and that's eventually going to be where that collapsing dragon entry is, right? If this price keeps improving, the MACD 4 seasons will go to spring. It'll get through the dragon. This entry is either going to be when the RL10 crosses the dragon, or if price itself takes out the PSAR. So sometimes price will run up so fast that you want to be into it and the RL10 is lagging. So if price goes through that PSAR, if all these other things have happened and price goes through the PSAR dot, then you want to just get long, and you want, as your standard risk box, the belly of the RL10. And so if that's your risk box, it's not unusual to see that you get 2 or even 3 execution risks on the way up. The first big decision you got to make is, when can I get to no lose plus dinner for 2? And then after you've gotten your risk out of it, it's now a science project. You're not going to lose money on that trade. Somewhere after you get about 2, I would say, 2 execution Rs in hand, and it's still working. And especially if you can see, if in your trading at 3 execution Rs is sort of an average win, or you can see some resistance overhead, somewhere around in here, then somewhere after 2, you want to activate your sniper so that if this comes up and then starts to roll over, you can activate the sniper and get the most of that. If it gets through 3R, then I just sort of automatically am thinking, hey, half my position's on the sniper, half is on the manager. Where am I going to put my second position in? And then I'm studying these upper price targets, observable, reasonable targets, like an RL270 or a VWAP, or if I'm trading intraday, it might be a range stat price level or some reasonable resistance level. So that template is how you get that done. Now, coming back to this one, what I want to say is this SFC or a COTA 2, what happens is it's the same thing. You get that, whoops, sorry about that. You get that harsh winter, crosses over the baby dragon, through the dragon. Somewhere in here, you get your entry. Those of you who have taken the other courses know that later on there's an owl entry. If you wait for the dragon to roll up and the RL30 to roll up, that's where you're getting an owl. If you go back to where the previous peak was and it takes out that previous peak, then any entry above that we would call an emerging dragon. And then you're riding that thing until it rolls over. And now you're thinking about, where are my exits? It might be a 1, 2, 3 exit. It might be on the near side of the dragon, far side of the dragon, or the PSAR. What we're looking for in this, sometimes it's a supported fall crossing, or it's a COTA 2, where you have a low and then a higher low. When we have these pullbacks that caused us to get out, and then it does a quick rehearsal, the briefer this fall, the better. I'd like to see if it comes through the dragon and then quickly gets back across the dragon. That's the RLXD, which is the COTA 2 entry. Okay. And I love that one too, because what you had was, in spite of the harsh winter, there was enough buying pressure to establish a local minimum and put together one good trade already. And then the guys came in and started buying it again. So now you're getting ready for leg 2. And that's what makes COTA 2 a continuation pattern, a buy on a temporary dip. And now we're looking to see that the size of leg 1 could be the size of leg 2. And that makes this a really low risk, high reward entry. Knowing all the time that my number 1 favorite pattern is the collapsing dragon. So in this price action, if it ever fails to go up further, and anywhere in here is failing and comes through the collapsing dragon, the original bend in the dragon or the RL10, if that price level ever breaches, man, you're on that to the downside for our favorite pattern, our number one pattern. Okay. Now, like I said, the audio and video from last night's Q&A session got disconnected. The first couple hours of the audio is pretty good because I was kind of just lecturing, but the last half hour was a detailed discussion and a picture drawing of these three patterns. So I wanted to re-record that with some visuals, and then also add this flashcard that talks about what those patterns are. Again, so if I put those two together, at the risk of, being really redundant, when I'm looking at the supported spring crossing, I'm looking for number one, harsh winter. Then the RL10 reversal, crossing the baby dragon. I'm just reading right off the list. The RLXD, winter, somewhere in here, the winter will turn to spring. Sometimes you'll get it. The sequence on these is not as important as the fact that it's all happening, right? You'll get price crossing the PSAR sometimes. And basically the way I want you to think about that is, if this is a slow and orderly move, as this thing is coming down the lip, as it's coming down the stack, you just are drawing these entry levels like a trailing entry stop. And then wherever this thing decides to turn, sometimes this will rocket through here so fast that it leaves the RL10 behind. And so when the RL10 crosses and you want to enter, you look up and you say, oh man, price is already way up here. I could have entered when it crossed the PSAR, and that's what I want you to do. But under more normal conditions, when this price rolls over, it's slowly grinding its way up through here. And then there's enough time for the RL10 to cross, and then you get an orderly entry. So that's what I mean by, you would prefer to enter when the RL10 crosses the dragon. You could expect to see somewhere in there that winter turns to spring. But if it's moving really fast and price crosses the PSAR, just go ahead and enter. So basically when either the price crosses the PSAR or the RL10 crosses the dragon, you can enter. And then your initial stop is either the belly of the RL10, and that's what I want you to do until you have 1,000 trades under your belt. Or because of the way the chart looks, you can see the dragon is the belly of the dragon is manageable, or you could have a minimum manageable risk box that's even closer. But the default position is the belly of the RL10, because that's the one that has the most, gives you the most wiggle room, and it'll still give you a reasonable reward to risk. So if this is my number two favorite pattern, number one is the collapsing dragon, as I said. And what we're looking for on that is the RL10 or the dragon made a high and is now reversed. So we got this thing up here. Then it comes down and makes a low. the RL10 or the dragon make a low, and they're reversing and going back up. But then instead of following through and taking out the previous high, instead of coming up here and taking out the previous high, instead it starts to fail. And then it comes down through this belly of the RL10, and then that's your collapsing dragon. And again, your initial stop could be swing high of the RL10. It could have been the previous PSAR, or if the RL10 rolled over here, it could have been this, or the peak of the dragon, or could it be just your minimum manageable risk box? So that's the number one preferred. And then the Kata 2 is nothing more than this thing moves up, pulls down, crosses the dragon, and crosses up to the upside again, and bang, you're just on it once more, just like I showed in the this one. It moves up, pulls back, crosses the dragon quickly again, and then you're on it for a Kata 2. All right. So offer that to you guys as a couple more flashcards to visualize these different patterns. Okay. All right. That's everything I got for tonight. I'm going to get the video from last night for the foundations guys, plus this last little audio chunk, and publish that for their FAQ. So, all right. That's everything I got for you guys. Take good care, and we'll be ready for tomorrow.